Welcome back to those subscribers to my Survive and Thrive YouTube channel and community. I would definitely love to have a lot more subscribers and likes on this channel, as well as the videos that I can continue to upload. So if you are finding interest in understanding more about financial investing and how to build yourself on the path to financial freedom, then please do your part, smash that like button, and subscribe. Just the way that the algorithm works, the more likes that we get, the more chances that other viewers out there can see my videos, and we can continue to build this community. Today, I wanted to go in more detail on a smaller portfolio that I have on E-Trade. I've been a long-standing member with them since they were actually referred to as Share Builder back in 2008 when I started this portfolio. And they went through a couple of changes. They got bought out at one point by Capital One, and then they eventually got bought out here by E-Trade. And so there's been some transitions along the way, but they've always been a good service, user-friendly, and I've always felt confident in ensuring the safety of my assets. When Share Builder originally started, they actually were allowing fractional purchases, so you didn't have to buy whole shares. And you're starting to see some of these exchanges, M1 Finance. I've got a video on that I've done a deeper review on, and so I'll put a suggestion link to that. And then there's also Charles Schwab is one that has started that option as well. But like I said, when Share Builder actually got bought out by Capital One, they converted back to whole shares only, and so every one of my positions got rounded to the nearest whole share, and then whatever was left got converted to cash. Like I had talked about in previous videos, this is an account that I started back in 2008, $50 a month, and I continue just to do that. So it's been a little bit over 12 years, 13 years since I've had this portfolio. And I just wanted to go in detail on each one of the positions that I do have. There's a total of 15, so quite a few to go through, but just want to touch on what each one represents and kind of my thinking and thought process back in 2008. Starting with the first, VTI, Vanguard Total Index. So a lot of my thought process back then is I had done a lot of research and findings on exchange trade funds, and so those seemed to be the safest as far as getting a start. So I was trying to limit my risk and decided to go with a lot of these index funds and or exchange trade funds. So that's a lot of what you'll see here in this portfolio. It still has very good returns, as you can see with some of these individual positions and the overall portfolio itself. But compared to some of my more aggressive portfolios that I do have out there on other exchanges as well as E-Trade, this one is on the lower end of return on investment. VTI is a good safe index. It represents the total stock market here in the US. And as you can see, I've got just 8 shares, not too many, but it does have the largest gain. Total gain percentage, 216%, or a dollar value of $1,321. The next position, Microsoft, everybody knows this name. Obviously a software corporation that was co-founded by Bill Gates along with Paul Allen. Once again, not a huge position, but it has some very nice returns here. 186.97%, dollar value almost $590. And then we start to get into a few of these exchange trade funds. So this first one, IYM, is an iShares that's based in US materials, and that has actually had some pretty decent returns. You can see I've got almost 9.5 shares, 83% return, $583. Pfizer is the next one. Pfizer I have covered also in detail on a previous video, so I'll put a link to that as well. This one is great because it's a biopharmaceutical stock, which when compared with most others is very stable, because the biotech industry in general is very volatile. And so this is a nice one because it just continues to grow. I get good dividends payback on it, and I don't have to worry too much about it going up and down too much over time. Currently right now I've got 43 shares, 38.68% or $582. And this one I'm going to jump down here on the list to VTRS that you can see down here below. And the reason why I wanted to talk about that is because in November of 2020, this was actually a merger with Pfizer, so it's another biotech company. And when they made the merger, there was a portion or percentage of each stock that you held within Pfizer. You'd also get a match with Viatris. So these are all free shares that I've gotten just because of that merger. So it's been another great just kind of dividend or reinvestment option. And then looking at the next one here below Pfizer, LMT, Lockheed Martin. So this is based off of the aerospace, defense, and arms industry. And this one has had really great returns as well, 36.5% or $206. IYR is another ETF. That's the iShares, and this is in the real estate industry, 32.8% or $314. EFA is also an exchange trade fund, and this is based kind of looking at the overall markets as well for stocks, but has to do specifically with any equities out there or companies that are outside of the US and Canada. So it gives me a little bit of those more emerging markets or other countries that aren't represented with your typical stock exchanges that you see here in the US. JP Morgan is the next one. Everybody knows them. Big bank in financials. And they've had some pretty good gains as well over time, 21.46% or $296. The next one, WBK, is actually Westpac Banking. It's a banking system that is based in Australia. And so it's another option or company out there that I'm trying to leverage things that are happening outside of the US. 19% return, not too bad. Only $13, so not a huge position there, but I still am ahead, so that's good. This next one, Hess Corporation, it's actually a developer, producer, and transporter of crude oil and natural gas, and they are actually based out of the States. 14% return, $154. AGG is another one of those total market, or in this case, it's specific to the bond market, but it's looking at the bond market performance in general. And I've got a 4.49% return on that, $47. We already talked about Viatris, so I'll skip that. NTDOY is Nintendo. And so that one I got into a while back when I started to see the new, this was prior to the Switch, but some of the new developments that they were headed towards and the vision that they were taking on, and then eventually they came out with the Switch. So this has had a little bit of a return, 3.87%, $13, not too great, drop in the bucket. Then the next one is KGC, Kinross Gold. So this is a gold mining stock. It's actually down right now, but I was trying to do this with this portfolio and specifically to balance out any sort of volatility if the stock market does take a dive. So that was kind of my goal with that. Right now it's down 4%. I've lost $25. And then the last one, Canopy Growth, and that's in the cannabis space. And it's one that I started buying into that I just thought that, you know, here in the next 3 to 5 years, we're going to see it really take off, and wanted to try and get in early and help build out this portfolio a little bit more. It's down 32%. I'm going to continue to dollar cost average and, you know, buy these ones that are on the low end, or, you know, in a buy opportunity, I would say. I still see the long-term vision for all of these, and I'll continue just to keep adding $50 a month until who knows when, next 15, 20 years. So like I talked about before, compound over time. That is the key to this. And so, like I said, if we do some easy math here, and I just take a look at 2008 to 2021. So that's 13 years, 12 months a year, 156 months times $50 a month. So $7,800. That should, in theory, be what my cost basis is. And so I'll jump over to a quick summary off of this portfolio. All right, so here's the summary. Right here, the total account value is $15,000, almost $400. And if I had just under $8,000 that I put into it, then I've made $7,500. Is it great money? No. Is it money that will continue to build and grow over time? Yes. And so a lot of my other portfolios are a lot more aggressive, and so I'm seeing, obviously bigger growth off of those and bigger returns. But even with a portfolio like this, you can still make some good returns. And, getting 34 to 35% return is still not too bad. So that's really what I wanted to cover today. Just wanted to show you a world example of compounding over time, and just how with even a little bit of money per month, you can make a lot more money. And that's really the whole goal of this, is to put yourself in a position to leverage money that you have sitting around and make it create more wealth for you and your future and your family, and get yourself ahead. Get yourself out of that consumer debt trap that is so well known here in the United States, and people can't seem to figure out how to get themselves out of it. And the best way is to never take on debt. I know it's easy to say, I've taken on debt. I'm finally in a position where I don't have that anymore. But the sooner you can do it, and like I've said before, if I could tell my past self or my younger self 10 years ago to just start investing more aggressively earlier, then I would have been out of debt sooner. So I could have saved probably 5 to 7 years of debt that I had to wade through and try and figure out, that I just would have gotten rid of that stress and been in a much better financial position today. So if there's others out there that want to leave comments about their approaches or what they're doing to get themselves to financial freedom, please definitely leave those comments below. I really hope you got value out of what I've covered today. If you have any more specific comments or questions about any of the positions or holdings that I have with this smaller portfolio, definitely also comment on those below. And like I said at the beginning of the video, let's build this community for the Survive and Thrive channel. I'd love to get to 1,000 subscribers this year. I know that's a huge goal, but I need every one of you watching this to help by hitting that like button to get this spread across YouTube and letting others see it, and then subscribing. I'm able to post at least one video per week, probably as we wrap up summer. I'll try to get back to maybe 2 per week. We'll see how time goes with everything else that I have going on. But I'm really happy to have this opportunity to be extending this knowledge to others and trying to help us as investors make some real money. So make it a great week as always, and I hope everybody is enjoying the summer. And don't just survive, thrive!